Hi, everyone. Thanks for joining a little bit early. I'm David Toll, publisher of Private Equity Career News. I'm going to be your moderator for the program today. We're going to get started in just a minute or two as we have a big crowd. We want to give them a chance to join. For those who did join a little bit early, feel free to download the handouts. You can do that from your control panel. You can get both the slide presentation for the program as well as a copy of the results of a survey of BD professionals that I conducted earlier this year. Also noteworthy on your control panel is the question feature. Please avail yourself of that and ask the panelists any questions that you have anytime during the program. That'll make the program more lively and interactive, and love to hear from your questions. So we're going to get started in just a minute or two. I see more people joining all the time. So hi everyone. For those of you joining just a little bit early, thank you for coming. There are two handouts that you can download from your control panel. One is the slide presentation for this program, and you can also get a copy of the results of a survey of origination professionals that I conducted earlier this year. We're going to get started in just a moment. Also a reminder, please ask lots of good questions during the program. You can also do that from your control panel. Okay, let's get started. Good morning, everybody, and welcome to a special Private Equity Career News webinar, How to Win Top Deals in Consumer Products and Business Services. My name is David Toll. I'm the publisher of Private Equity Career News. I'm going to be your moderator for today's program. I'd like to start out thanking our sponsor, SPS by Bain Company. They are an award-winning provider of actionable data and analytics for private equity firms seeking to optimize their deal sourcing efforts. Before we get into it, a few housekeeping announcements. First, a friendly reminder to any reporters on the program today that we are off the record, so please reach out to the speakers individually for permission if you'd like to use anything that they say today in an article. Second, you can download a copy of the slides from your control panel, and I would recommend that you do that now. You can also download a copy of the results of a survey of BD professionals that I conducted earlier this year. About 100 origination professionals participated. It's got a lot of valuable information on industry-wide origination practices. Later today, you will get a recording of the program and a link to the handouts, so no need to take extensive notes. And finally, many of you asked questions of our panelists when you registered for the program. We will plan to address those questions during the discussion portion of the webinar, but please also ask questions at any time during the program through the question feature on your control panel. I'm grateful to have 4 expert speakers today to guide you through the topic, starting with Nadim Malik, founder and CEO of New York City-based SPS by Bain Company. Nadim will present statistics revealing the state of the M&A market and also address the role that technology plays in helping deal originators see a high percentage of transactions. We have Laura Holden. She is an investment banker with Raymond James. She advises healthy living and wellness companies operating in such markets as food, sports nutrition, and fitness. She advises them on capital raising and M&A transactions. Justin Loeb is a vice president and investment banker at Clearsight Advisors. He's worked as a sell-side advisor to a host of companies operating in business services. And we have Gretchen Perkins, partner and head of origination at private equity firm Avance Investment Management. Avance is geared toward acquiring lower middle market companies in a variety of sectors, including consumer products and business services. So with that, let's find out a little bit more about our speakers. We'll start with Laura. Tell us, Laura, more about Raymond James and your role there.
Thank you, David. It's nice to be with all of you today. And I'll give a little bit of background on myself and Raymond James. So I'm a director on the consumer team at Raymond James, and interestingly came onto the platform via acquisition earlier this year. So my firm was called Financo, a specialty kind of high growth branded consumer investment bank that had been around for almost 50 years, was acquired by Raymond James earlier this year. Raymond James has built much of its investment bank through acquisition, and so it was a very interesting meta experience for me to be a part of a M&A deal, having spent a lot of time working on M&A transactions. It was the first deal that I've been inside of. I've been a consumer investment banker for the past 15 years. Prior to Financo, I was with Stephens, which was my first foray into the middle market, and when I started covering healthy living businesses. And prior to that, I was with HSBC for 6 years right out of school. Before banking, I played lacrosse at the Division I level at the College of William and Mary, and I'm from Baltimore, and now I live in New Canaan, just outside of the city. So happy to be with you all today.
Thank you, Laura. Justin, tell us a little bit more about Clearsight Advisors and your role there.
Absolutely. Yeah, first off, thanks for having us all, David. It's going to be a great panel. So I'm also a fellow William & Mary grad, just like Laura. Go Tribe. So I'm a vice president at Clearsight, and I lead two different functions for the group. We're an M&A advisory firm of about 40 professionals today, focused exclusively on serving kind of high-end professional services, IT services, and tech-enabled services businesses. I lead the sponsor coverage group, which most of the folks in attendance are probably familiar with that sort of role. But the other area that I spent a lot of time in is our newly formed principal investment group that we call our merchant banking practice. And what that is, and we've been talking about it for years and finally really set it in motion 6 to 9 months ago. But it's the primary purpose is providing growth capital to earlier stage consulting and IT services and tech-enabled services firms that aren't yet ready for a larger recap or strategic sale, and so aren't interested in hiring an M&A advisory firm, but could use some growth capital to kind of get to that larger transaction more quickly. And the capital markets historically for human capital intensive businesses like a consulting firm have been pretty, there haven't been very many. It's been very unsaturated. So we've kind of worked to fill that gap by doing $1 to $10 million checks per transaction, below anything that any of the sponsors we work with on the sponsor coverage side would be interested in. But as you can imagine, pretty good sources of referral, and the two roles kind of are quite complementary to one another. So we just closed our first transaction about 2 weeks ago. It was an investment in a Salesforce consulting business, and we'll be announcing it more broadly here over the next couple weeks.
Fantastic, Justin. Congratulations on the start of merchant banking effort. That's awesome. Gretchen, tell us more about Avance and what you do there.
Sure. Hey, everybody. Thanks for joining, and great to see my friends here on the panel. See you as we are doing these days. I'm Gretchen Perkins. I'm head of originations at Avance Investment Management. We're a new private equity firm birthed in COVID, And we have two headquarters, one in Miami, that's the office I'm calling in from, and one in New York City. So we are focused, as David said, on lower middle market businesses in the consumer and services broadly sector, looking for businesses with between 5 and 30 million of EBITDA. I've been in private equity originations for over 20 years now, always in a business development role. And I was a commercial lender for about 13, 14 years before that. So career in financial services. I'm originally from Detroit. I've been in Detroit for almost all of my life. So I've made a big move south to join this new firm, and really excited about it. Excited to be here.
We're excited to have you, Gretchen. Thank you. And let me now turn the baton over to Nadim, who's going to go through sort of the formal presentation portion of our program. And after that, we'll get back into a roundtable discussion to address the questions that you all have. Nadim?
Good morning, everyone. And thank you, David, for moderating and putting this all together. Thank you, Gretchen, Laura, Justin, for joining us today. I'm really excited about the panel, and welcome to the audience. We hope the next hour is of interest to you, and hopefully you get some good stuff out of it. I'm Nadim Malik. I'm CEO of SPS. Before starting the company over 11 years ago, I was a internal data person for a middle market private equity firm's BD efforts. Even then, I looked up to Gretchen as one of the pioneers in the business development area. And it's been great getting to know her and work with her over the years. And you know, that 11-year entrepreneurial journey with SPS culminated with us being acquired by Bain Company, the consulting firm, last December. So we're now a wholly owned subsidiary of Bain Company, working with private equity firms, as well as M&A advisors, lenders, and other service providers in this space to use data and technology and analytics to give them an edge around their deal sourcing or business development or what have you. And as I talk to different folks in the industry, I think everyone recognizes and understands that they have to use data, they have to use technology, you know, they have to be on the cutting edge of those things, but there's a lot of questions around how, you know, how do you do that? So before we turn things over to our panelists, as David mentioned, just thought I'd frame the conversation with a few slides, beginning with the current market. And woo, what a market it is. Haven't seen anything like this. When you talk to consultants, M&A advisors, PE folks, I can't remember a time where consistently across the board I'm hearing that folks are turning down business. It's crazy. And we can certainly confirm what's going on with the data. If you look at this chart, private equity activity was up a staggering 57%. And, you know, first half closed deal announcements are still coming out. So it's safe to say it'll be up 60% or more in the first half of the year compared to prior years. So it's crushing its peak set in the first half of 2009 and 2018, about 20% higher than that peak. And both corporate and private equity M&A activity, very, very robust. Moving on to the next slide. The trend that we've seen in prior years of the buy and build and roll-up strategy accelerated even further so far in 2021, with PE firms now completing well over 2 add-ons for every platform that they do. The secret is out on this. We don't need to go into the details of why this strategy is so attractive. And in 2 simple words, you know, multiple expansion with growth and synergies and cost savings. But you know, I do want to take the opportunity to mention, look, if you're a middle market or upper middle market private equity firm, and you know, you're accustomed to a certain cadence around your deal sourcing and business development and relationships, and if you're leaving add-ons to your portfolio companies, there may be an opportunity for you to get proactively involved. The universe of lower middle market brokers is very fragmented. It's ever changing. A lot of firms do quiet, limited processes, and sometimes the portfolio company can feel like they have the pulse on the market and the companies, but not, you know, and having the data and understanding and kind of working with them to identify potential opportunities from this broker and intermediary universe might be something worth getting involved in and looking at, as this strategy is, you know, grows to be more and more compelling and drive positive returns for private equity firms. Moving on to the next slide, where have sponsors been putting their money to work on a sector basis? Here's a look at the most active sectors for private equity in the first half of 2021. Service businesses, one of the sectors we're covering in this panel, is leading the charge, followed by IT and healthcare. And then, you know, the consumer food retail sectors, which we highlighted here, the second area we're covering on this panel, has close to doubled in the time period. So I think they're very, very relevant topics and sectors to be covering on today's panel, and I'm looking forward to the discussion and Q&A. Moving on to the next slide, let's look at sponsor acquisitions by seller type. Private companies represented 63% of all private equity acquisitions in 2021, edging past the 62% height reached in 2020. To be perfectly frank with you, I continue to be very surprised by this. At some point, with all the years of increasing private equity activity, all of which portfolio companies eventually need to exit at some point, PE sellers should represent a higher share of sell sides over time, but we're not seeing it in the data yet. It's very interesting. So something to keep our eyes on as the years progress, and as an investment banker, you think about your strategy in terms of sponsor coverage and where your focus might be. Moving on to the next slide, deal flow in Q2 2021 was the highest we've ever seen. So this looks at the median number of deals a private equity firm sees per quarter. In Q2, at 227, it towered past the prior peak set in Q2 2019. You saw that big dip in Q2 2020 due to COVID, but it's come roaring back. And I think it's safe to say, given from the time deals get logged or seen, there's, you know, on average, according to our analysis, around 7 months it takes to close a deal. That given this robust deal flow, that closed M&A activity should be robust in Q3 and potentially into Q4 as we head out the year.
Nadim, if I could interrupt you
Sure.
for just a second, thank you for putting numbers to why I cannot keep up with my email, with my inbox. This is really.
Gretchen, you're drowning, and I'm happy to paint the picture, paint it for you. You know.
Thank you.
Give you the scenery. Yeah, it's crazy what we're hearing, and certainly it's playing out in the numbers. But I don't, you know, it's not sustainable both from the deal flow and closed deal activity. There's so many forces at work on both ends. You know, the backlog from COVID and you know, some of the tax changes and some of the other things pushing a lot of closed deals to get done. My working hypothesis is things are going to slow down next year, maybe a 10% drop, but I'm not the expert. You know, we track the data. We got the panelists. I'm looking forward to their thoughts as they see all those forces and work and where it's headed. So, look, you know, moving on to the next slide. Put your data geek hat on. There's a lot of intense information on this slide. I'll try to break it down because I find it interesting. And we're kind of in a unique position to talk this. So the first thing are the bars. They represent the number of deals similar to the prior slide. So you can see the same number for Q1 2021, 168 deals. And if we had the Q2 numbers on this slide, it would show, you know, it towering past the prior peak. So the bars are the median number of deals seen. And the lines represent the percent of deals that actually end up closing that private equity firms see. I don't mean their closing rate, which is typically like 1% or, you know, give or take. This means, you know, closing at all, period. And that, you know, the fact that they've kind of hovered in the high 30% is going to come as a surprise. If you're not familiar with this chart, we actually published this in a series we call The Science of Deal Sourcing, and this is the 7th year we're doing it. So yeah, it's probably going to come as a surprise if you're not familiar with this, but it's really interesting to see how that closing rate has dipped. If you look at the deals that we're seeing at the end of 2019, a lot of those got stalled or maybe just got put on hold completely due to COVID and what was going on. So the closing rates of deals seem to be dipping. It'll be very curious. Some of those are going to come back, eventually end up closing, just take significantly longer than in a conventional market. So be curious to see how the market coverage stats, I'm sorry, not the market coverage, but the deal closing stats increase over time. Moving on to the next slide, as we all go back in the road, like it or not, SPS, our team, puts together some rigor and analysis around how to prioritize that. So an analysis like this, where you can see what are the cities where intermediary or other deal sourcing professionals that you focus on, or portfolio companies that you're focusing, potential targets that you're focused on, are clustered, and that where you're not seeing deals. So, and then not only getting the raw data behind that, but sometimes it's very helpful to get out of the weeds and look at a map. Those clusters really jump out. And so, we suggest putting some thought behind this. There's only so many cities you can travel to. And it takes a lot of effort to plan those trips and get the most out of them. And if you're going to do it right, this, and probably another time to mention how important it is to keep contact data current. Since the beginning of COVID alone, we've seen over 100 new intermediary firms pop up, do a deal for the first time. And not to mention the professionals, that are hopping and switching and starting new firms or switching organizations. So critical to keep that data current. Seems like a simple point, but I can illustrate it very simply. Just imagine any trip that you're taking. Let's say you're going to Chicago, meet some firms. You could literally be in a building where there's an intermediary that could have the perfect deal for you, and just totally go back, and not even know about it because you didn't know about that firm or didn't have the contact data in your system. So it's a very important part of the entire process. I'll also mention as the conference season heats up with ACG and other conferences and industry trade shows, we have a conference evaluator tool that allows firms to kind of prioritize, pop in the intermediary attendee list, and within seconds you can see who, as a private equity firm, who you would be the best use of your time based on your investment criteria and their closed deal history. So definitely, excited about travel. But it's helpful to put some data and rigor behind that as you prioritize that, and everyone gets back on the road, hopefully. Finally, I'll conclude with one last point and slide. One of the areas beyond just intermediary and alternative deal sources and opportunities for sourcing, one of the things we've seen, David, if you don't mind moving to the next slide, one of the things we've seen is an increasing appetite on the part of private equity firms to source directly from other private equity firms. So we spend a lot of time at SPS as keeping that data as current as possible. And this is both of interest, for investment bankers as well as private equity firms. According to our data, and we updated this a couple of months ago now, at that time, there were over 5,000 private equity portfolio companies that were acquired in the 2010 to 2017 timeframe that had not exited. And logic dictates they need to be coming to market soon. And on the left, you can see the breakdown by size at the original time of transaction. So those have probably increased in size for most of those companies. And in the middle, you can see the breakdown by sector. And over to the right, you can see the top private equity companies that hold those. And within the SPS portal, you can mine this data by sector size, geography, maturity, specific PE fund, who the sell side advisor was on the original deal. A lot of times you end up hiring the same firm. And even if, you can't preempt a deal, a lot of times you're going to hire a banker, as you know, but having that access and to the management, to the team, to the company beforehand, just saves a lot of time and could help you if it ends up being a company that's really of interest to you. And all this stuff can be analyzed in the portal, and we also send customized alerts every week as reminders when relevant private equity assets just hit their 3-year maturity, for example. So that's my little SPS plug to conclude my presentation. So with that, I'll turn it over to David and the panelists for our discussion and Q&A.
think you're on
David,
mute.
at least for me, you're on mute.
I'm usually very good about that. So Nadim, just picking up on your last point, with so many portfolio companies ripe for sale by private equity firms, Gretchen, I'm just wondering, do you do anything special to stay in front of the private equity firms directly, or is it largely about working with the intermediaries that they hire?
No, we actively reach out and signal to other private equity firms that have portfolio companies in our wheelhouses, like food and beverage, or you know, financial services, technology services. So definitely, we do exactly what Nadim was describing, which is we know they're going to have an investment bank, but if it's something we really like, you know, we will have our head of research, you know, prepare the market map of that target long before that company ever comes to market, so we can show up and have the research done, the knowledge of the opportunities, a plan, a thesis for how we are going to continue to create value, because the first private equity firm probably pushed a lot of the normal private equity levers. You know, what are we going to do differently, and how are we going to grow it? And you know, the idea is we want to come in and preempt a process when Justin or Laura show up and say, hey, we're going to market with this deal. And we say, we know this deal, we love this deal, we know all about it, we're ready to move now. And doing all of that work up front, you know, a thematic approach allows you to have the courage to, you know, to pay up, which you have to for a private equity owned asset in, you know, in a sell side process. So, and we are a subscriber of SPS, and I can tell anybody who's in business development on this call, it's super helpful. Especially to me, joining this new firm. There's several sectors we invest in that my prior firms did not, like healthcare services, financial services, staffing services. And so I don't have, you know, 20 years of relationship with those bankers. So SPS allows me to see who are the firms and who are the people at those firms closing deals in those spaces in particular. Super helpful if you're, you know, if you're new to a sector or you're new to BD. It can give you a real jump start on getting to know those people. And frankly, it's been invaluable during COVID times when you can't, you know, go to a conference and bump into people and meet these people. So you have to actively do the outreach. So I found it to be super valuable to me. But frankly, you know, there's this balance between, you know, being thematic and proactive and reaching out to other private equity firms is there's only so much time you can dedicate to that because of the slide Nadim showed, which is, you know, it is a crazy amount. You know, I reported out to my firm at a Monday morning meeting a couple weeks ago. I said, you know, deal flow levels can only be described as staggering. I mean, I've never seen anything like this in my career. And I was really gratified to see that slide, Nadim. I'm going to send that around to my founder. So, see?
Thanks, Gretchen. Sticking with the theme of a frenzy of activity out there, I want to ask the audience, many of whom are BD professionals, what they expect the year to end up with in terms of deal activity. So let me tee that up. The exact question is, how do you expect your firm's total number of platform deals this year to compare with 2020? So go ahead and make your selections from down from last year, I'd be surprised, to more than 10% higher than last year.
Are you talking deal flow or are you talking closed deals, David?
Okay,
if the count may be down because their firms have been in, you know, selling things this year, it's a great time to sell.
Yeah, closed, I definitely mean closed transactions. Thanks for clarifying. Okay, close the poll. Now I'll share the results with everyone. So as expected, more than half of participants expect the number of platform deals they close this year to be more than 10% higher. And I'm going to ask a related question, and that's related to add-on transactions. So very similar question. How do you expect your firm's total number of closed add-on deals this year to compare with 2020? And you have the same choices, ranging from down from last year to more than 10% higher than last year. And let me share the results with everybody. They look pretty similar to what we just saw, with this time half of you expecting more than 10% higher number of add-on deals. So no one's expecting the second half to be much different from the first, it looks like. And with that, we're going to go into the roundtable discussion portion of our program. First off, again, please, if you have any questions for our panelists, just go right to your control panel and ask them through the question feature. I'll also reserve about 10 minutes at the end of the program for more of a kind of a pure Q&A if you're inclined to save your questions for the end. So let me start with Laura. And Laura, tell us in the areas that the sectors that you focus on in the consumer land, what your what's happening to deal flow, what's happening to deal prices.
Yeah, absolutely. Great questions, David. And similar to Gretchen's sentiments, so I've been in banking for 15 years, and when I joined in 2006, it was boom time, and I didn't have the perspective to really understand how robust that deal environment was. But I can say with some confidence that this environment is more frothy than even then. And just to give you a flavor for that, I'll never forget being an analyst on one of my first pitches. It was in the beverage space, and we were showing 9 times leverage. So 9 times debt to EBITDA, and not having any other perspective, I thought, okay, this is normal. And then in hindsight, obviously, that's an amazing amount of leverage, and just a snippet into how robust that environment was. Now, I think the difference is you have firms that are very aggressive. They're industry focused, and there's this whole new crop of direct-to-consumer businesses that are doing really amazing things, being able to harvest data in the consumer space in a way that it was never done before. So that is some of the excitement. I'll say in terms of valuations, they're quite heavy. I'll say one thing we've been spending a lot of time thinking through, though, is that the private market is kind of frothy from a valuation standpoint, but the public markets have also been, in some cases, even more pronounced in terms of a valuation premium for some of the consumer businesses operating in new categories, whether it's plant-based beverages or plant-based food, whether it's different businesses touching the fitness category or the apparel kind of technology-enabled apparel space. There are these really amazing multiples in the public realm that in some cases actually put the private valuations into better perspective, don't make them look as kind of toppy. And then I'll just mention a couple areas that I think are some of the most exciting within consumer that we're spending time in and around. Healthy living, certainly, that's an area that I've focused on for several years now. It's becoming table stakes coming out of the pandemic, which it's still hard to get my head around that we just maybe are even still going through a pandemic, a global pandemic. And so, 80 to 90% of consumers expecting to spend more on their health, preventative health, through supplements, through better food, through fitness, kind of grabbing the reins there. So still a very important sector for us. Beauty is a sector that we've, my prior firm, Financo, that is now part of Raymond James, differentiated ourselves in the marketplace for our amazing beauty practice led by Vinette Ho, who's done an amazing job. And I'll say an area, kind of a subset within that we're really excited about is beauty technology. And that's a high growth space that is evolving kind of real time. And then third, and something very close to my heart in terms of thematic areas where we're seeing more capital flows, would be modern parenting. So businesses, services, elevating the parenting experience for predominantly dual income families. You're seeing millennials kind of graduate into the chaos that is early parenthood, and then you're seeing a crop of entrepreneurs creating products and services that better cater to that consumer that's maybe used to spending a little bit more. So I just mentioned those are the three areas that when I think about it, I think there's even more to come, and there's been a tremendous amount of deal activity around.
Laura, I probably should have heard about beauty tech before, but I have not. So can you tell me what that is and maybe give a quick example?
Yeah, absolutely. And I can't mention any companies in particular in this forum, but think about any businesses that are in the beauty space that are relating either data or kind of real insights beyond just an Instagram model saying, hey, this pineapple extract worked for me. Something that's more kind of science-backed, efficacy, bringing in a data tracking component, bringing in a higher level of efficacy, which is where we're seeing everything shift in terms of beauty. Again, not just like a trust me, but actually consumers wanting to see results. And again, not to bring it back to millennials, but I think this trend started a few years ago as millennials are aging, needing actually results in a way that they didn't before. And we've become a super visual culture. We're seeing a rise in aesthetics, the aesthetic segment of beauty, because of exactly situations like this one where people are staring at their face on screen in a way that they've never done before, and we think that'll continue.
And you've got the aging the boomer generation who will spend almost any amount of money.
Absolutely. Hey, Laura, you mentioned when you first broke into the business, a 9 times leverage. That sounded fine to you.
Yeah, had no perspective otherwise.
What is leverage today available on consumer companies?
Yeah, so it's a great question. I'd say what it really comes down to for the businesses that we work with is what is the level of comfort with leverage, and what is the appetite for their new potential partner to take on leverage, because it does have some meaningful kind of governors to the way that some of these businesses want to grow, and so you don't necessarily want to be boxed in too much by covenants, but I would say anywhere from 3 times on the low end up to 6 times in some situations for credits that are having a nice kind of cadence of historical cash flows and a good margin profile, and kind of some of those aspects, those fundamentals of making a company kind of credit worthy. We've seen that full range, and I think it really does. I think the availability is there, maybe even a little bit higher than that with mezz or with kind of other creative ways to just top up leverage. But I think it comes down to what is the management team comfortable operating in terms of a levered balance sheet, how the partner is looking at that, and I'll say thankfully in the areas that I play, it's not a situation where we're trying to get the last dollar of leverage, because those partners are trying to really figure out how to maximize growth, and again, not have to like have a hard talk every quarter when you kind of take a look at the covenants.
Right. Thanks, Laura. Justin, let's move to you. And now you're focused on business services. Tell us about deal flow in the sectors you focus on, and also address deal pricing.
Absolutely, yeah, happy to. So within business services, where we really focus is kind of in that white collar professional services, IT services space. So certainly a really large subset of business services, but not as much on the kind of HVAC and plumbing and janitorial services and some more of the blue collar stuff. We'd like to find someone to actually lead a practice there. It'd be a very complementary adjacency for us, but we're not doing a ton there. But because of that, a lot of just about all of the companies we work with, quite frankly, have some sort of technology component. And they don't need to be selling their own software, right? They could be implementing a third-party software provider solution. But there's a technology component, and sometimes it's just in the know-how and kind of what's between the ears of the professionals working there, so to speak. And so what's happened is you've got all these broader, really favorable market trends, right? Whether it's the interest rate environment, the rhetoric, which is slowed and kind of calmed down, but the rhetoric around kind of changes to long-term capital gains taxes, right? You've got a bunch of people hungry to put money to work on the financial sponsor side, who weren't able to, certainly during Q2 of last year in many cases, and some struggled in Q3 as well of last year. And for these sectors specific to us, you've got strategic buyers that quarter after quarter, year after year, are getting much more sophisticated as how they approach M&A, right? You've seen the Deloittes and the Accentures of the world and Ernst & Young's have fully built out corp dev teams for a while. I mean, Accenture deploys $1 billion to $1.5 billion a year on M&A, and it has for a few years. But you're seeing a lot of other players in the space ramping up their teams and M&A efforts. And then at the same time, when you look at the companies we're working with, just at a company level, there's a ton of momentum and tailwinds, frankly, coming out of COVID, because everyone is prioritizing their digital initiatives much more so than they were pre-COVID. Just 100% in 100% of cases, right? Whether it's how people are interacting with their own employees or trying to get a 360-degree view of their customer, or whatever B2B kind of application or scenario you want to describe. I mean, technology is becoming more and more important, and prioritizing those digital initiatives is top of mind for every C-suite. And so what that means is the demand for the services and solutions that our clients are providing are kind of at all-time highs. And then we've got all the broader macroeconomic trends that everyone's talking about and has been for the last 6 or 7 months. And it's just the stars are aligning, David, and we cannot hire enough people to keep up with the demand for folks trying to explore, in most cases, a full sale, but in others, just taking advantage of the market and trying to raise some growth capital. And even those, they go out to raise some capital and they end up turning into majority recaps or sales, just because the valuations are so much more attractive for kind of change of control deals, right? And so anyway, it's certainly the most active market I've seen in the last 10 or so years. And everyone seems to echo that sentiment from folks I work with who have been doing it a lot longer.
And Justin, what are you seeing in the way of pricing trends in business services? What are things going
it's really interesting. So valuations are certainly at or above kind of the highest they've ever been for these subsectors. And you can see it in the public markets, to Laura's point too. I mean, of all the publicly traded kind of business consulting, IT services, digital services companies we track, basically all of them are kind of at 90, somewhere between 90 and 100% of their 52-week high. They're at kind of all-time high multiples and have rebounded completely, and then some from their kind of pandemic lows, right, in Q2 of last year. And so pricing is very high, but what's interesting about these processes is because valuations are up and because the market is so frothy and active, we're actually, for a lot of really high quality assets, we're actually getting much less interest than we anticipated and would have gotten pre-pandemic. The interest we are getting is sincere. There's high levels of conviction, and people are trying to race ahead and preempt, kind of like what Gretchen was describing. But the total number of bids from a normal 2-stage M&A auction are actually way down in a lot of cases, even for really, really nice businesses, which we weren't expecting. But it makes sense if you think about it. Everyone's, you got to pick your battles, right? And everyone's bandwidth constrained, and so valuations are up, but actually total number of bids are down. Does that answer your question, David?
Yeah, that's really interesting. What about Laura was talking about the leverage that's available these days for consumer products companies in the 3 to 6x range. What about business services?
Yeah, I think it's similar. I think it's a little bit less for us, and probably more like 2.5 to 4.5, maybe 5 times. And the reason being, a lot of the companies we work with are more project-based in nature. And so most people probably think you can't even get 3 or 4 times on these project-based services businesses, but you absolutely can. And if you need names of lenders that can get comfortable, let me know. Feel free to reach out directly, because you absolutely can. But you're not going to, you usually won't get north of 5 times if something's really more of a project-based model, even for assets that have 15, 20, 30, 40 million of EBITDA. It's just, it tends to just be a little bit of a stretch for lenders, but pricing's very attractive, and certainly the lending environment is as good, if not better, for these assets than pre-COVID.
And Justin, with
David,
go ahead, Nadim.
Sorry. No, you continue, David. Then I had a question for Laura and Justin, if you don't mind.
Okay, I just had one more question follow-up for Justin, and that is, are there any subsectors, Justin, within IT services and digital marketing services that you talked about that are particularly hot or kind of new on your radar just within the last year or so? Absolutely.
Yeah, great question. So if for anyone that is kind of in the IT services world, I'm sure you've seen that every private equity firm out there seems to have a managed services provider platform, an MSP by now, and if not, they are looking and continue to look very aggressively. And many are looking on a proprietary kind of deal basis, because it's just the processes for these MSPs and we've done a couple in the last year, and they're just very, very active, and it's very difficult to compete. And so people are trying to find them on a proprietary basis more and more. An area that's a bit newer, where there are a couple platforms, and I expect it to be at probably almost, if not more, saturated maybe this time next year, as the MSP world is kind of on the digital services, really outsourced product development and custom software engineering. Think like the publicly traded players in the space are like Globant and EPAM and Endava, and they're growing so quickly that they're trading for 40, 45 times EBITDA in some cases, and have been for a while. And so, you saw the GlobalLogic deal in the last couple months. They sold to Hitachi, and GlobalLogic had changed hands a number of times before that, and that was a really high multiple deal. And there's more and more investment in kind of the outsourced product development and custom software engineering space. And it makes sense, because again, this goes back to some of the what I was talking about coming out of the pandemic. When you think about the Fortune 500, when you think about the Global 2000, whatever, as long as there's a budget for spending on technology, I mean, whether it's a mobile app or a web page or some kind of wearable or other digital product, every enterprise out there is trying to figure out their strategy and how to implement their strategy for building these digital products. And they don't have teams of software engineers in-house a lot of times, and so they have to outsource that. And so these groups that are kind of go-to partners for building the software, maintaining it over time, even helping with the strategy in some cases, they all approach it a little bit differently, but they're just growing, 30, 40, 50% plus year over year, even with a lot of scale. And that's attracting a lot of attention. And then, the exits to like the GlobalLogic exit and some of the success in the public markets has just attracted a lot of financial sponsors as well. So we get a call, it seems like every other week, and in some cases some pretty, $3, $4, $5 billion funds too, that are trying to put money to work in this space, and have struggled because a lot of these deals happen on the upper end of for some of the mega funds, a lot of these deals happen much earlier. And so getting their hands on opportunities, but also still being able to deploy a couple $100 million of capital per, for a platform for them has proved challenging. And so we're running into that and trying to help a couple different firms actually find digital services platforms of scale, but these strategics keep swooping in sometimes out of processes and paying 30 plus times EBITDA. So it's a really interesting space. I think you'll see more and more investment over the coming quarters.
Yeah, that sounds like a very very hot market. Nadim, you had a question.
Yeah, it's amazing how time flies. It's crazy. It's already 11:50, and I want to get Gretchen's perspective. She brings a wealth of knowledge, and especially for other BD professionals that are in different stages of their career. But I had one question before getting back to Gretchen. I have one additional question for Laura and Justin. Can you just how much is the potential tax change fueling seller interest, given the flurry of activity? Do you think it's going to continue into next year? Are you guys staffing up to prepare for that? Are you forecasting a decline? Any remarks around this? I think a lot of people are wondering that.
Definitely. Well, I'll just jump in. So certainly the perception that the capital gains tax rate would increase and potentially go as high as ordinary income tax, which is, I think, outside the realm of possibilities, at least from my humble opinion. I don't think I can speak on behalf of the firm or other firms that we're very close to on the accounting side that have given me a little bit of ability to stand on that ground. But that certainly did, I think, create an interesting wave of transaction momentum at the start of this year. Certainly, as we got into summer timeframe, I think ultimately, though, it probably won't move in the extreme direction again towards ordinary income tax rate that was, for whatever reason, percolating in the stratosphere among business owners. So I think there will be this artificial additional bump of deals that hopefully get done in December. But I think overall the transaction kind of momentum will persist because there is just a lot of capital in the market. There's strategics that have built up war chests of a lot of cash. There are private equity firms that have newly minted funds or new fund vintages preparing for something kind of leading up to 2020, not knowing what that would be. So there's new funds, both within the established players and with the newer players. And so there's a hungriness, I think, across the industry that'll continue to drive transaction volume aside from cap gains. And I kind of struggle with what the news reports in terms of what's happening with the tax rate and what is in actuality going to happen, particularly next year as it is an election year. I think it feels like it would be the wrong move to move taxes up and then expect voters to vote kind of folks into the seats that they're trying to get. So but that's my perspective, Nadim, which is, yes, it has driven some of the momentum, but I think the momentum will persist because of the capital environment.
Yep. And I'll just keep mine real short because I probably took too much time in my last response, but I agree. And the only thing I'll add is, if you do look at kind of the max rate for long-term capital gains taxes over the last 30 years or so, it's basically only gone down or plateaued, right? So when you spend trillions of dollars, combating a global pandemic, and at some point, I feel like the max rate will go up. Will it go up to ordinary income? I really don't think so, to Laura's point. And when it'll happen is still up in the air. Did it fuel a bunch of going to market in the last 6 to 9 months? Yes, it did. And I do think, because of everything Laura said, that'll continue next year, even though the rhetoric around some of the changes has softened.
I'll throw my 2 cents in. I think our government has multiple higher priorities that they can't get done. I have zero confidence that they can get anything done. It's certainly not capital gains tax. So sadly. So the good news is the specter that after the 22 elections, the Dems will change it, I believe that will continue to drive owners wanting to go to market before that changes. I think all the, in addition to the strong economic things Justin cited, I think we will have this specter in the background driving deal flow all through 2022.
Say, Gretchen, I'd like to stick with you and have you talk about what deal flow you're seeing there and what kind of prices you're paying or passing on, as the case may be.
Sure. We are seeing there's no surprise that we've got Clearsight, which is a specialist in tech-enabled businesses and technology businesses, and Raymond James and Laura, who are specialists in consumer. And Raymond James just made a giant investment in Financo. That shows their support for consumer. We're seeing a ton of consumer deals in exactly the sectors that Laura outlined: health and wellness, supplements, fitness products, better for you food, all sorts of co-manufacturing businesses that are increasing product lines for other brands to, maybe that weren't in a healthy space that are now launching a healthy offering. So lots and lots of food deals and DTC consumer deals, non-food. So those businesses all, they are recession proven, pandemic proven. Those types of businesses have been growing so strongly through 2020 and into 2021. So the question is, in these DTC businesses, and any business really, consumer that had a COVID bump, does that continue? They bumped up their sales, and can they sustain that, into a non-COVID world, which I thought we were getting close to, but maybe not. So that's to be seen, how some of those deals perform, and we're kind of lapping the COVID year now, so so that's interesting. We're also seeing a lot of technology businesses, tech-enabled businesses in multiple different sectors, but I seem to see a ton of digital marketing consulting businesses. Just there's so many, and they're all growing, right? Because every company wants to increase their digital presence for all the obvious reasons, and they're finally spending money on that and not just relying on the sales and marketing department in-house to do that. They're actually hiring the experts, because you need that. It is a big data exercise. It's combines a lot. It's clearly not just marketing. That's simply the delivery vehicle in digital marketing. So those are the two sectors that I'm seeing a lot of. Prices are double-digit EBITDA margins for all of those sectors that I've looked at. If it's a deal of size, which to me is anything over $5 million of EBITDA.
Gretchen, how is this crush of deals that everyone is describing actually impacting the dynamics of individual processes, and then how are you responding?
Yeah, it's Justin alluded to this when he said the number of bids for their good assets are actually down, and that's because lots of private equity firms are just saying no to deals that they would normally go after for bandwidth reasons. The inflow is so great, and for any investment bankers that are on the call, if I don't answer your first email, that's just because it got buried. Please ping me again. All of us PE folks need all the help we can get in seeing the deals as they come in, and I sadly am typing too often, geez, thanks for bumping this up. I missed it the first time. This is something we're really interested in, etc. So we're all trying to hire the same people. Justin and Laura are trying to hire the same people we're trying to hire, the mid-level and junior level execution folks. They're in very high demand all throughout the industry, and it's really a challenge, especially as a new firm. We're really trying to staff up in all areas. So bandwidth is really a throttle on how many more deals can show up on Nadim's slides that are closed. I think, we try to triage them as they come in and say, okay, we only have limited bandwidth. This is a nice deal. We don't, ordinarily, in ordinary times where we had more time, we would like to create an angle. We don't have an angle on this, but we can create an angle, right? That's what private equity firms do. You find the executives that are experienced in that space. You find your board members, your outside board members, you hire consultants, and you can create an angle for any sector we want to pursue. But in the hot processes that Justin and Laura are running, there's no time to create an angle. For good deals, they're going to run 2 or 3 of us to the finish line with not granting exclusivity, many times, not always. But if it's a private equity owned business in a hot process, my experience has been there's no exclusivity provided, and for those types of auctions, if you will, we're just saying we don't have the bandwidth to compete that hard to win something and then not walk away with it. So we're trying to manage ourselves in that way. Nadim?
Question for you, Gretchen. This is something I hear a lot from BD professionals, and sometimes we connect people to get a feel for this. And when you talk about the current market and the deal flow and things are changing, the question is this: like, where do you, in your experience, what have you learned is the optimal kind of equilibrium between business development professional and deal execution professional, the handoff of the deal? For example, like, how far do you get involved? Do you stay involved in the deal? Like, in your world, if it was up to you, like, what would be the optimal, like, is it earlier in the process, like catch and release, and so you can just find your next deal? Would you rather stay further along? Just talk. I think people, BD professionals earlier in their career trying to figure out the optimal structure here, and especially in a market like this where you don't want those emails to kind of sit there for too long for the relationships. Talk a little bit about that.
Yeah, I think there at some point in your career, and I did this early in my career as a lender and early in my career in private equity. I used to run models, right? I don't run models anymore, but I know what goes into a model. I know what questions to ask. I know in certain industries, there's certain variables in that financial model that will really impact the growth or the lack thereof, or the margin trend of certain businesses. And I need, I feel that Laura and Justin want to talk with somebody like me who can ask those intelligent questions and really pre-qualify an asset. So, for every business development person on the line, I'd say you need to be very conversant in deal dynamics and financial dynamics, because otherwise, Justin and Laura, when I say, we are really interested in this, they know that Gretchen does know, and she knows what her firm wants to do. She knows what you can deliver. If you're not asking smart questions at the teaser stage, and Laura and Justin, jump in. You know whether that person really understands the business and gets what's different about it. It's probably pretty easy, whether they're just a messenger or they're actually somebody who's representing and has some knowledge about what the firm can do. Over time, I've had varying levels of involvement at the 3 different private equity firms I've worked with. Some, at some point it's catch and release, which is generally earlier in your career. But as you build the relationships with the deal referral sources, you'll be involved much further into the process. So you get the deal, you pre-qualify the deal, you do hand it off to an execution team. You need to do that because you got to go back to, on the road and get the pipeline stuffed for 6 months from now so that you have things to hand off to your execution people. So, it's difficult to stay very involved deeply. And frankly, I don't want to sit in front of a computer doing spreadsheets anymore. I don't want to do that. So the relationships I am making with deal referral sources provide information as you're going through the process. I can call these guys up or others in the industry, and I can say, hey, what is this business owner really looking for in a partner? Like, do we really have a chance? Like, is this business owner looking for someone who's had, 3 other portfolio three other investments in this sector and really know it cold? Because we don't. And if not, we should jump out of this process now. So I think it's the relationship that you build gives you more information about how the firm should spend its resources, right? We don't want to go hard after a deal that we really never had a chance of winning for some reason. And so you'll stay more involved. For instance, in one of through closing. And then you'll stay involved by looking for add-on acquisitions. And frankly, in one of our portfolio companies, I've been very involved in chasing down an add-on acquisition. Very, very, very involved, so that the deal team and the management team doesn't have to. Right? We're all dealing with short bandwidth, so we got to go with our strengths. So it really varies, and it varies by what your firm wants. Some firms say, we don't want you involved beyond the handoff. Go get more opportunities, and you can be successful in both models, for sure. But I'm leaning now at this point in my career more involved longer, and certainly very involved in add-ons, finding and courting and teeing up add-ons.
Thanks, Gretchen. We're going to finish the program addressing questions that have come in. We have a number that have queued up and about 10 minutes to address them. So let's start with the technology question, and has to do with just the evolution of software and database tools for deal originators, for deal intermediaries, and what do you see coming down the pipe? Nadim, can you tackle that one?
Yeah, I'll hit it really briefly because I think there might be some interesting questions, and our panelists, they're just doing a great job. There's a wealth of knowledge here. Technology at best is an accelerant. It creates efficiency. It does things automatically that you don't have to do with greater precision. And that's why things like getting data integrated into your CRM platform, getting alerts set up, making travel efficient, all these things which we strive to do for our clients with our offering are the areas of technology that and analytics are going to help. I think the big race on a deal sourcing side is to create actionable, kind of predictive, capable private company data information, like what triggers, things that trigger signals that this is a high growth company or maybe coming to market, and for that kind of proprietary direct sourcing. I'm not aware of a tool that's done it, but I know I could probably think about 10 that are trying to do that right now. So that's like the big thing I think everyone's trying to figure out. Let's see. So hopefully that addresses that question as succinctly as I can.
Thanks, Nadim. We have a question, well, first a comment and then a question. This registrant participant said, I recently learned about a $1 billion deal between 2 private equity firms where the period from letter of intent to signed purchase agreement was 2 days, 2 days in all caps.
What?
Are you seeing this as a normal process? And this, I think this is part of a larger issue which Gretchen touched on when she talked about the disappearance of a period of exclusivity. So the question for Laura is, how do you see processes that you're running changing in response to this high level of deal activity? And
Yeah.
and how do you advise your clients, private equity firms, kind of deal with it effectively?
Yeah, it's a great question, David. I think back to Justin's point, we have seen some real culling of the playing field earlier on, because I think there is a bandwidth issue. Folks are figuring out what opportunities they have a right to win within and are leaning in there, and then not spending time on things that are cuspier. And so we have a smaller set of players than prior years, I would say, on the whole, for wonderful businesses. For that reason, I think deal certainty is something we hold like a tiny little baby bird, like just making sure that throughout we're not making a decision that puts our client at a disadvantage in terms of actually getting a transaction across the finish line. So we are seeing less traditional exclusivity periods with 30 to 45 to 60 day timelines, and we're running more people through to the finish. In terms of, and I kind of missed the stat on maybe the 2-day turnaround on the purchase agreement or something of that nature. I don't think we're seeing anything extreme to the point of negligence in terms of having to make people run hard and fast. But I think we're trying to do the best that we can early in the deals to identify who are those parties that are leaning in, and then again, really helping them, spending more time earlier in the process with business diligence than we traditionally ever would, opening up data rooms on the reverse side of indications in some cases to really get a sense of who's digging in, and just trying to be creative, utilize the Zoom environment to have more exposure with the management team and kind of snackable meeting types. And we're just trying to stay kind of dynamic throughout this deal environment.
Justin, any advice for private equity bidders on dealing with the new dynamics of how these auctions are going?
Yeah, I think even when companies end up, especially for the founder-owned and operated businesses, I think even when they end up hiring us and running a process, I think the firms that have gotten in touch with companies ahead of time and have started to develop a relationship and are doing things on a more proprietary basis, I think they have a leg up. And I think what's interesting is, a lot of times I'll ask folks in my network, how much proprietary deal sourcing you're doing, and they'll sort of talk around it because they feel like I'm going to be upset if they're trying to find a lot of deals outside of like our processes or other advisors' processes. But the reality is, they should be doing it, and I think you're seeing more of it already. And that trend's not going to slow down at all as more and more funds are raised, funds get bigger and bigger, and you've got to put money to work. I mean, people are going straight to the source. They're absolutely trying to go around intermediaries, but they should. And frankly, when they hire an intermediary, it should be better for every party involved too. Because one of the things I can tell you from now being on the direct investment side, now granted, these are much, much smaller transactions, but they none of these firms have advisors. And so what you run into a lot of times, and anybody on this part of this conference that has tried to do a deal without an advisor and maybe has succeeded, that it's much harder for a variety of reasons. And so even if you have to compete, if you establish a relationship earlier on and somebody hires an advisor and they run a process, you're in a good position for that process if you're doing what you're supposed to be doing and building that relationship. And at least you know that if they've hired an advisor, chances are there's going to be a deal to do at the end of the day versus spending a couple of years with a firm, talking to them and keeping it warm, and then they never hire anyone. They talk to a few parties. We see this a lot, right? It sometimes is good, good lead for us on the M&A advisory side. Somebody tries to run the process on their own, doesn't get something done because they didn't really know what they were doing to begin with. And then once they hire an advisor, whether it's us or somebody else, they're able to get a successful transaction done. But I think having that, if you do have the resources to get in front of companies early, and you have a strategy around targets you want to get in front of, right, versus just kind of being a generalist, and then it's really hard to get in front of companies because you don't know which ones you want to get in front of. But if you have a strategy and you get in front of them early and often, I think even if they hire an advisor, it's a winning formula.
I agree. I mean, the unicorn that is a proprietary deal is great, is great, but they have a far lower hit close rate, because we know if we're seeing a deal from an advisor, you guys have scrubbed the numbers. Maybe you haven't done a sell side Q of E, but you have asked all the right questions, because your time is your most precious asset, and you're not going to waste your time on something and find out there's some big scary accounting issue that really changes the EBITDA. So we like the reliability of the numbers you see from advisors, for sure.
Okay, we have about a minute left, and a final question for you, Gretchen. With so many opportunities flooding the market, are you changing your criteria for investments? Looking for deals, say, in new sectors or geographies, doing things differently?
I think the only thing that we're doing differently temporarily, because of bandwidth issues, is we're very much prioritizing founder-owned businesses over private equity-owned businesses. We have reinforcements coming in late August. We have a couple of things taking up a lot of time internally, all good news, that is consuming bandwidth. And so I would say, for now, given the environment, given how fast those processes move, and given that the seller, if you're a private equity firm, really doesn't care about bonding with the new buyers and having a relationship, and what we think are some of our best skills are the people we bring and the relationship we make and can create with an entrepreneur. So we're prioritizing founder-owned deals right now.
I'd love to add one just thought into or on top of what Gretchen just mentioned, which is hopefully something that the folks on the phone can take away, which is for those founder-owned situations, our management teams, our founders, are looking for real people that they want to spend time with on the other side of the transaction. So humanizing yourself in even just your initial intro, talking about where you're from, where you live, if you have children, whatever it is. It's such a subtlety, but I think it goes a long way with these founders who just want to understand who the people are that they're working with. And then I'd also say a show of force is important, I think, as long as it's not intimidating. But if you're just showing an interest in a particular asset, recently it was part of a fireside, and there was 4, even 5 folks on the line from this sponsor that was really interested. They had a prior founder, they had an operating partner, they had a couple junior people on their team dial in and just humanize them, and I thought it worked beautifully. So just something that you could take concretely away.
It's a really good point. Thank you.
Okay, guys, we are out of time. I'd like to thank everyone who registered and came and asked great questions. I'd like to thank our sponsor, SPS by Bain Company, for making the webinar possible. And I'd like to thank our speakers for doing a great job with the program: Nadim Malik of SPS by Bain Company, Laura Holden of Raymond James, Justin Loeb of Clearsight Advisors, and Gretchen Perkins of Avance Investment Management. Enjoy the rest of your day, everyone.
Thank you.
Thanks, everyone.
Thank you.
Take care. Bye.
Bye.